Mortgage rates just ignored what should have been a major global headline, and it tells you a lot about where I think things are probably headed next. Uh, Over the weekend, we had some pretty, what should have been very, very negative headlines. We had failed peace talks, and normally that kind of headline would have pushed oil higher, bring bond yields lower, and create that sort of risk off environment across all markets, especially the stock market. Now, all of this ties into mortgage rates. I'm going to explain how. And if you've listened to some recent episodes, you'll really understand, I think, better what I'm saying and how it all ties together. Now, when the headlines broke this weekend, what you saw is exactly what you would expect to see. Oil spiked. There was some movement in bonds, and the market futures reacted the way you would expect, declining. But notice what happened on Monday. By the close of the day, Monday came and everything just reversed. Oil actually dropped throughout the day. And the stock market ended up higher, and bond yields rose, and mortgage rates did not rise. Interestingly enough, in the end, actually rates stabilized. So the big question is, what just happened? Why did the market completely shrug off the headline of failed peace talks between the United States and Iran? And I think it's important to note this because it's going to tell you where things are probably headed and how mortgage rates are probably going to stabilize from here on out. All right, so what I see is 4 key reasons. Okay, and I think once you fully understand this, you'll understand how the market is thinking right now. And this is really important because I think this is a big tell to what the bond market is doing and to where rates are going from here. All right, so the first point is this. Nothing actually changed. Even though the headline sounded important, this major headline comes out and, peace talks fail and negotiations fail between the United States and Iran. It didn't sound good. It sounded like, well, I guess oil's going to go up and markets are going to crash. But really, nothing really actually happened. There was no major escalation and nothing that actually would impact the economy, at least near term, really took place. The market didn't react to the headline the way we thought it would, right? It's thinking a little bit more ahead. I'm going to get to that in a few minutes. Now, the second point, this outcome was probably already expected. I think a lot of traders in the oil markets and the bond markets were probably already positioned for the possibility that these talks would just fail. So I think when it actually happened, it wasn't a surprise. The market moves on what are surprise headlines, not an expectation. So that takes me to the third point, and probably the most important thing right now. The market is really focused on inflation. It's showing you, it's kind of telling you that it's not looking at geopolitics anymore. It's done with that. It priced everything in for that. The bond market is telling you inflation is my issue, my primary concern. So the expectation is that rates are going to stay higher for longer. That's what the bond market's telling you. So even though oil moved around, it didn't change the bigger picture when it comes to inflation and what the Fed will do next. And the Fed, for the most part, doesn't look like it's going to cut rates this year anymore. That's why you saw bonds selling off and yields moving the way they moved. So this takes me to the fourth point. And this is a bit more kind of an advanced point, but it's that the market, and I've said this before, it's a very forward-looking thing, right? I think, and I mentioned earlier, I think it's already priced in the worst-case scenario. Over the last few weeks, markets have really, to see oil go that high over $100 a barrel, almost, I think it got all the way to $115 a barrel for oil. That's tremendous. That's a tremendous move. The stock market declining 10%, bond yield soaring, I think markets have been preparing for a much more severe outcome. It normally overshoots, and I think that it was pricing in a very prolonged conflict, a long war. I think it was pricing in the possibility of maybe even, the United States sending in ground troops. I think even, other countries getting involved, in the conflict, causing a potential, major, conflict between multiple countries, multiple regions. And, that kind of scenario would have had a much bigger impact on oil inflation. I mean, the entire globe, right? And ultimately interest rates, of course. But I think what you're seeing is, at least for the moment, those worst case outcomes don't look like they're playing out. The market is kind of telling you, we don't think that's going to happen. And when the market realizes that the worst case scenario is not happening, even if just for now, it will adjust very, very quickly. And that's what you saw today. That's what you saw today on Monday, April 13th. You saw the market adjusting very quickly and saying, you know what? I think we've already priced in the worst case scenario, and it doesn't look like it's going to happen. So, obviously there's positioning unwinding too. You have short covering and things like that. I won't get into the nitty gritty of kind of the market dynamics, but I think the bottom line is, you went into the weekend, a lot of traders positioned for fear. They were buying bonds and oil as a hedge. And then when there was no escalation, I think those trades got reversed, and quickly market turned around real fast. Oil came down, bonds sold off, yields moved higher, and mortgage rates therefore stabilize. So when you put it all together, the message for the market is pretty clear, in my opinion. It's not reacting to headlines anymore. It's reacting to what actually changes. And right now, nothing changed. And that's why mortgage rates didn't move really in any direction. Even with such a major global headline over the weekend. And going back to why I think this is a major tell is because, to me, it goes back to the show I did on Friday, and perhaps it does show that perhaps oil did peak, and we may be seeing the unwinding of all these positions, and now what will at least create some stability with interest rates and mortgage rates, which can maybe calm some, potential investors and buyers of properties calm down. I think there's some nervousness out there. I think a lot of you are seeing that, and I think it to me, what I saw today was a good sign of perhaps sort of that unwinding and maybe stabilization that I think we all would love to see. And hopefully the headlines get even better, and hopefully this all comes to an end soon. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time.